Shell's return to Canadian gas through ARC Resources could change the energy industry because it gives one of the world's biggest LNG players a stronger grip on the fuel that affects your bills, your jobs, and your country's leverage. For you, this is not just a corporate takeover. It is about who controls the next wave of North American gas exports to Asia and possibly Europe. Shell once stepped back from Canada's oil sands, but now it is moving back into Canada with a deal that tells a very different story about where global energy power may be going. The price tag is big, but the signal is bigger. And the proof is not in the announcement alone, it is in what Shell came back to buy. In 2017, Shell made a move that looked like a retreat from Canada. The company reduced its exposure to the Canadian oil sands, selling major interests in a sector that had become expensive, politically difficult, and harder to fit inside the future Shell was trying to build. The sale was worth about $7.25 billion, and at the time, it sent a clear message. Shell was no longer willing to carry the same level of risk in one of the most capital-heavy parts of the global oil business. The oil sands were not small. They were not irrelevant. They were one of Canada's biggest energy symbols, but they came with long timelines, high development costs, major emissions pressure, and a constant need for political defense. For a company trying to protect returns and reshape its portfolio, that mattered. But Shell did not leave Canada completely. That is the part many people missed. Shell stepped back from one kind of Canadian energy. It did not walk away from the country itself. It kept its position in Canadian gas. It kept its place in the Montney. It kept its role in LNG Canada. It kept a line of sight to the Pacific coast. And for years, that looked quiet. It looked like a side bet. It looked like a patient position waiting for the right moment. Then, on April 27, 2026, that moment arrived. Shell agreed to buy Calgary-based ARC Resources in a deal valued at about $16.4 billion in enterprise value, or roughly 22 billion Canadian dollars. ARC is not just another producer. It is one of the most important Montney-focused gas companies in Alberta and British Columbia. And Shell's move was not a random purchase. It was a strategic return. The acquisition would add about 370,000 barrels of oil equivalent per day to Shell's production. It would help lift Shell's production growth outlook toward 4% through 2030. It would add roughly 2 billion barrels of oil equivalent in proved plus probable reserves. And it would combine ARC's more than 1.5 million net acres in the Montney with Shell's existing roughly 440,000 acres. Those numbers matter, but the deeper meaning matters more. Shell is buying scale. Shell is buying reserves. Shell is buying drilling inventory. Shell is buying gas near assets it already understands. And most importantly, Shell is buying a stronger supply base for LNG. That is why this story is bigger than one corporate takeover. Every energy giant faces the same hard problem. Wells decline, fields age. Production that looks strong today must be replaced tomorrow. If a company produces heavily but does not replace enough reserves, investors eventually ask the same cold question. Where does the next decade come from? ARC helps Shell answer that question. It gives Shell gas. It gives Shell acreage. It gives Shell reserves. It gives Shell more control over future supply. And because ARC's Montney position sits in the same broad region as Shell's Groundbirch assets and the LNG Canada supply chain, this is not just gas sitting on a map. It is gas that fits into a route. That route leads to Kitimat, British Columbia. That route leads to LNG Canada. That route leads to Asia. And that is where the entire story changes. For decades, Canada has had a strange energy problem. It had huge resources, world-class workers, deep engineering skill, and major production. But when it came time to sell natural gas abroad, Canada was heavily dependent on the United States. Most Canadian gas exports flowed south. That made sense because of geography and existing pipelines. But over time, it became a weakness. When you have only one main customer, you do not control the relationship the same way. When your product has only one main exit, the buyer has leverage. When your gas has to move into a market that is already producing huge volumes of its own gas, your price power is limited. That has been Canada's gas trap. Canada could produce, but it could not fully choose. LNG Canada gives the country another door. When LNG Canada shipped its first cargo from Kitimat on June 30th, 2025, Canada crossed a line it had been trying to reach for years. Phase 1 has a capacity of 14 million tons per year. Shell owns a 40% stake in the project, and if Phase 2 is approved and built, capacity could eventually double to 28 million tons per year. That first cargo was not just a shipment, it was a new route to the world. Canadian gas could now be cooled, loaded onto ships, and sent across the Pacific. It could reach Japan, South Korea, China, India, and other Asian markets that care deeply about secure energy. It could give Canadian producers another customer. It could give Canada another source of leverage. It could reduce the old dependence on US-only export routes. This is why Shell's ARC deal matters so much. An LNG terminal needs feedstock. It needs gas for years, not weeks. For an LNG company, gas supply is not a detail. It is the entire foundation. Without enough secure supply, a liquefaction plant becomes a very expensive piece of infrastructure waiting for molecules. Shell knows this better than almost anyone. Shell is one of the world's largest LNG players. It does not only produce gas, it trades it, ships it, markets it, balances it, and sells it into regions where energy security can shape national policy. Shell understands that LNG is not just a commodity. It is a contract, a route, a relationship, and sometimes a geopolitical weapon. That is why the ARC deal is not simply about today's production. It is about long-term LNG supply security. Shell is strengthening the upstream side of a system it already wants to dominate. Gas from the Montney can support LNG Canada. LNG Canada can reach Asian buyers. Asian buyers want reliable supply from stable countries, and Shell wants to sit in the middle of that chain. That is the strategy. Gas in the ground, infrastructure to the coast, LNG on ships, buyers across the Pacific, trading power across the world. This is not a sentimental return to Canada. It is a supply chain move. And it comes at a time when energy security has returned to the center of world politics. Russia's invasion of Ukraine reminded Europe that gas supply can become political pressure. Middle East tensions have reminded markets that shipping routes and choke points matter. Asian economies still need reliable fuel for power, industry, and growth. And countries that once trusted global markets to solve every shortage now understand that security has a price. That does not mean Canada automatically wins. It does not mean every buyer will pay any price for Canadian LNG. It does not mean Shell has solved every issue. LNG buyers compare cost, contract terms, shipping distance, emissions, flexibility, and political risk. Canada still has high project costs. It still has regulatory complexity. It still has climate politics. It still has Indigenous rights and consultation issues that must be handled seriously. It still has long timelines. But Canada now has a stronger argument than it had before. It can say it is a stable democracy. It can say it has massive gas resources. It can say its Pacific coast gives it a route to Asia. It can say it is not Russia. It can say it is not dependent on one unstable region. It can say it can help allies and partners diversify supply. That argument is not enough by itself, but in today's world, it is no longer ignored. And Shell appears to believe that argument is valuable. For Canadian viewers, this deal is about much more than corporate finance. It is about whether Canada can finally turn resources into leverage. Canada has often had the raw material, but missed the premium. It produced the oil, the gas, the minerals, the lumber, and the power, but too often sold into limited channels while others captured more of the strategic value. The ARC deal points to a different possibility. If Canada can connect Montney gas to LNG export markets, it can move from being a supplier trapped by geography to being a supplier with choices. Alberta and British Columbia become more connected to the Indo-Pacific. Canadian producers get more market options, Ottawa gets a stronger energy security argument with allies, and Canada gets a chance to show that it can build major infrastructure when the national interest is clear. For American viewers, this also matters. The United States is already an LNG giant. The Gulf Coast has become one of the most important LNG export hubs in the world. American gas has reshaped Europe's energy survival since Russia's war in Ukraine. US LNG has become a tool of diplomacy, trade, and industrial power. But Canada's West Coast has one advantage the US Gulf Coast cannot fully copy: geography. British Columbia is positioned for Asia. LNG cargoes from Canada's Pacific coast can reach key Asian markets more directly than many shipments from the Gulf Coast. That does not mean Canada replaces the United States. America has massive production, established infrastructure, deep capital markets, and huge LNG momentum. But it does mean Canada can become a more serious competitor and partner in the same global game. That changes the North American energy map. For years, Canada sold a huge amount of gas into the US market. The US had infrastructure leverage. Canada had resource strength but fewer exits. Now, if Canadian LNG grows, Canada gains another path. That could affect pricing, pipelines, investment, and bargaining power across North America. That is why Washington should pay attention. A stronger Canadian LNG sector does not weaken America automatically. U.S. companies can invest, supply equipment, trade cargoes, and benefit from a stronger North American energy bloc. But it does reduce Canada's dependence on one customer, and that changes the relationship. This situation is moving fast. By the time mainstream media covers the full picture, the moment to understand it will have passed. Subscribe so you are always ahead of the story, not catching up to it. Because the biggest mistake right now is to see this deal as only a business headline. It is not. It is a reserve replacement story. It is an LNG story. It is a Canada story. It is a U.S. energy competition story. It is an Asia story. It is a global security story. And it may become a super major story. When Shell makes a move like this, other companies notice. ExxonMobil notices. Chevron notices. Total Energies notices. BP notices. Asian buyers notice. Pension funds notice. Pipeline companies notice. Provincial governments notice, Ottawa notices, Washington notices. That does not mean a rush is guaranteed, but it does mean the market now has a fresh signal. If Shell believes Canadian Montney gas is worth this level of investment, others may start asking what they are missing. The competitor angle says Shell figured it out first, and Canada is now holding all the cards. That is too simple. Other companies and investors were already watching the Montney and Canadian LNG. Canada is not holding all the cards. It still has to execute. It still has to prove that it can permit, finance, build, and operate projects at scale without drowning them in delay. But the bullish argument has a real foundation. Canada has what many buyers want: resource depth, political stability, proximity to Asia, and a chance to offer LNG from a country that is not a strategic rival. In a world where energy buyers want security as well as price, that combination matters. The question is whether Canada can turn that combination into power, because resources alone do not create power. Infrastructure does, routes do, contracts do, political discipline does, regulatory clarity does, trust does. This is where the ARC deal becomes a test of Canadian seriousness. Shell can buy gas, Shell can strengthen its position, Shell can build a larger Montney platform, but Canada still has to decide what kind of energy country it wants to be. Does it want to be a country that talks about helping allies but cannot approve and build projects fast enough? Does it want to be a country that has world-class resources but sends most of its gas south because it lacks export options? Or does it want to be a country that can sell into global markets while setting high standards and protecting local rights? That is the real national question, and it is not easy. LNG supporters argue that Canadian gas can help Asian countries reduce coal use. Coal is still a major fuel source in parts of Asia, and replacing coal with gas can reduce some emissions in power generation. Supporters also argue that Canadian LNG can give allies and trading partners a more secure alternative to supply from unstable or hostile regions. That is one side. The other side is that LNG is still fossil fuel infrastructure. Critics warn about methane leaks, long-term emissions, high costs, and the risk of locking in gas use for decades. They argue that capital should move faster into renewables, storage, grids, energy efficiency, and clean industrial systems. Some Indigenous communities support energy projects, especially where ownership and revenue sharing are real. Others oppose projects because of land, water, climate, and rights concerns. Both realities exist at the same time. That is why this story should not be turned into simple cheerleading. Shell's return to Canada is significant. It is not automatically risk-free. It does not guarantee LNG Canada Phase 2. It does not guarantee that Asian demand rises exactly as companies forecast. It does not guarantee that future gas prices justify every investment. It does not guarantee that Canada becomes the world's next great LNG hub. But it does prove something important. Shell sees enough value in Canadian gas to spend billions deepening its position. That is the hard signal. And hard signals matter. The deal strengthens Shell's long-term feedstock position. It gives Shell more room to support LNG exports. It adds reserves at a time when reserve replacement matters. It gives the company a larger position in one of North America's best gas basins. It places Shell more deeply inside Canada's attempt to move from US-dependent gas exports toward global LNG markets. That is the story. Not that Canada has already won. Not that Shell has solved every problem. Not that LNG demand is guaranteed. The story is that one of the world's most important energy companies is acting as if Canadian gas tied to Pacific LNG exports has become strategically important. That is why the timing matters. Before LNG Canada shipped its first cargo, Canadian LNG was still partly a promise. It was a project. It was a debate. It was an argument about what Canada might become. After the first cargo left Kitimat on June 30th, 2025, the story changed. The route was real. The facility was operating. The Pacific Link existed. Once the exit exists, the value of nearby gas changes. The gas itself did not move on paper, but its future market did. That is what Shell is buying. It is buying gas with a better path out. It is buying acreage that can feed a global strategy. It is buying future LNG flexibility from a country that may become more important in energy security. This is why the 2017 comparison matters. In 2017, Shell stepped back from Canadian oil sands exposure because that part of the portfolio no longer fit the future it wanted. In 2026, Shell is moving deeper into Canadian gas because this part of Canada may fit the future better. That is not a contradiction. It is a pivot. Shell is not saying Canada was wrong then and right now. It is saying the kind of Canadian energy that matters has changed. Oil sands were about heavy crude, high costs, long timelines, and major emissions pressure. Montney gas tied to LNG is about supply security, global markets, Asian demand, reserve replacement, and export optionality. That is a different business case. And if that business case proves right, the Montney becomes more than a basin. Kitimat becomes more than a port. LNG Canada becomes more than one project. ARC becomes more than one acquisition. Canada becomes more than America's energy warehouse. It becomes a possible swing supplier in a world that wants secure gas. That is the part that could change the industry. Because energy power is not just about who has the resource. It is about who can move it, who can sell it, who can sign long-term contracts, and who can keep supply flowing when the world gets unstable. The United States already understands this. Qatar understands it. Australia understands it. Russia used gas leverage for years. Now Canada is trying to step into that conversation in a larger way. Shell's ARC deal does not complete that shift, but it pushes it forward. It puts pressure on Canadian policymakers. It puts pressure on infrastructure planners. It puts pressure on competitors. It puts pressure on LNG Canada Phase 2. It puts pressure on the idea that Canada can remain content selling most of its gas into one market. And it puts pressure on critics and supporters alike to answer the same question. What is Canada's energy strategy now? Do you think Canada should push harder into LNG as a national priority, or is Shell making a risky bet on a gas future that may not last as long as companies hope? That question will define the next phase of the debate, because Phase 2 is not automatic. That point needs to be clear. ARC may improve Shell's supply position, but it does not remove every obstacle. A Phase 2 expansion still needs commercial alignment, partner support, financing, regulatory approval, fiscal clarity, market demand, and political confidence. It still has to make sense in a world where costs can rise and climate policy can tighten. That is why the phrase, "could change the energy industry forever," must be handled carefully. Could it change the industry? Yes. Has it already changed everything? No. The deal is a major signal, not the final result. If Shell succeeds, it may prove that Canada can become one of the most strategic LNG supply platforms in the world. If other majors follow, the Montney could become even more valuable. If Phase 2 advances, Canada's LNG export capacity could double at LNG Canada alone. If Asian buyers lock in long-term supply, Canada's role in the Indo-Pacific energy market could grow sharply. If Europe continues looking for secure democratic suppliers, Canadian LNG could gain more diplomatic value, even if Asia remains the natural main market from the West Coast. But if approvals stall, if costs climb, if gas prices weaken, if LNG markets become oversupplied, or if political support breaks down, the deal may look less like the start of a new era and more like a large bet in a crowded market. That uncertainty is real. Shell knows it. investors know it, Canadian officials know it, environmental groups know it, competitors know it. But major energy shifts always begin before the outcome is obvious. By the time everyone agrees, the best positions are usually gone. That may be the logic behind Shell's timing. It is moving after LNG Canada proved the route could operate, but before Canada's full LNG future is settled. It is buying a major Montney producer before the next wave of possible competition becomes unavoidable. It is adding reserves while reserve replacement is under pressure. It is strengthening supply while LNG buyers are still thinking hard about security. That is not accidental. That is strategy. And it shows how the energy transition is actually unfolding. For years, many people spoke about energy like it was a clean switch. Old fuels down, new fuels up, fossil fuels out, renewables in. But the real world has not moved that neatly. Power demand is rising, data centers need electricity, emerging economies need growth, heavy industry still needs reliable fuel. Coal remains deeply embedded in some countries. Europe still worries about gas security, and governments want lower emissions without losing reliability or affordability. That messy reality gives LNG its opening. Shell is betting that gas will remain necessary during the transition, especially if it can replace coal, support power systems, and provide secure supply to countries that do not want to depend on unstable sources. Critics argue that this is how fossil fuel infrastructure keeps extending its life. They warn that every new LNG project creates pressure to keep producing and burning gas for decades. That is the central conflict, and the ARC deal sits right inside it. For workers, this could mean more activity in Alberta and British Columbia. For businesses, it could mean new investment. For governments, it could mean tax revenue and geopolitical influence. For consumers, the effect is more complex, because globalizing gas through LNG can sometimes support higher producer prices while also improving long-term supply security. For investors, it offers growth potential, but also commodity risk. For Indigenous communities, it can bring opportunities where partnerships are real, but also serious concerns where impacts are not accepted. For climate policy, it creates another hard debate about whether gas is a bridge, a backup, or a barrier. That is why the story is not simple, but it is important. Energy shapes prices, it shapes industry, it shapes trade, it shapes alliances. It shapes whether countries can stand up to hostile suppliers without wrecking their own economies. It shapes whether governments have options when crisis hits. And options are power. For too long, Canada had resources without enough options. Shell's ARC deal is a bet that this is starting to change. If you believe the US and Canada deserve honest, clear coverage, not spun headlines and corporate talking points, this channel was built for you. Subscribe and stand with every viewer who refuses to look away from what is really happening. So here is where the story stands. Shell stepped back from part of Canada's old energy model in 2017, but it did not abandon Canada. Now it is moving deeper into the Montney with a $16.4 billion ARC deal that adds production, reserves, acreage, and a stronger supply base near LNG Canada. The main tension is clear. Shell is betting that Canadian gas tied to Pacific LNG exports will be more valuable in the next decade than many people understood. But the next question is even bigger. Can Canada build the pipes, terminals, partnerships, approvals, and political confidence needed to turn that gas into real global power? Because if Canada hesitates again, the opportunity may not disappear. It may simply be captured by someone else. In my next video, I am covering how Canada's LNG push could challenge America's energy dominance, and what I found will change how you see this.